Hello everybody again. This is Hugh Johnson, obviously the chairman of Hugh Johnson Advisors, and it's nice to be back with you. Let me give you a little bit of a sense as to what our thinking is on the financial markets, the economy, the global economy, and as maybe some of the geopolitical events that are transpiring right now and how they might affect the markets. This is an important moment because we're now at the 112-month mark of this bull market, which makes it the longest bull market in the post-war period. And that alone is enough to raise some issues or concerns, questions, if you may, as to when this bull market will end. Or is it a time right now that we should start to reduce our exposure to the stock market, which we've had at a fairly high level for all of our investors, all of our clients for a fairly long time? The answer is obviously there is no answer to it. Nobody has a crystal ball. But being as long a bull market and being as successful a bull market for most of us has been, the truth is that it's been a real success. And I certainly never would blame anybody for saying, look, I'm getting a little bit of cold feet, I'm getting a little bit of discomfort, I can't really sleep at night, I'm very concerned, so I want to take a little bit of money off the table or reduce my exposure to equities. That doesn't really, that's not really an irrational sort of a decision to make. At the same time, when I'm asked, do I think that the bull market has further to go? My answer to that question is yes, I do think it has further to go, and it's primarily because our disciplines, not because of me internally. I get as nervous as anybody else, but our disciplines, which is a review of performance of the financial markets, review of the performance of important economic variables, our reviews tell us that indeed we do have further to go in this stock market economic interest rate cycle. The performance of the financial markets, the trend in the stock market since the low that we saw in February when we had that real significant decline, 12% decline in stock prices, the trend in the stock market has been up. Investors have been, of course, buying some of the so-called economically sensitive bull market sectors. Technology and consumer discretionary stocks are doing really well. Small capitalization stocks, smaller companies are doing better than large companies. Again, it's a sort of an indication investors are becoming increasingly more optimistic about prospects for the economy in general and the earnings of small cap companies in particular. And we do have in all of our portfolios an exposure to small cap companies using exchange traded funds. It's also the case that the economic variables are fine. They're still consistently positive. The index of leading economic indicators, indicators that tend to lead the economy, tell us where the economy is going, have been up for 23 straight months. 2 months they were unchanged. And that also is sort of confirming the performance of the financial markets. So the financial markets and the economic variables together collectively are telling us that there's reason to be reasonably optimistic about prospects for the economy and most importantly earnings as we look through the remainder of 2018 and into 2019. So that's all really positive. If there's any concern, it's that the market has gone up. It's a little bit ahead of itself, a little bit overvalued for the second quarter, over the level that we would forecast for the second quarter of 2018. A little bit pricey, but there's still upside potential in our view as we do the valuation work of about 4.5% between now and the end of 2018, and still positive for the outlook for 2019, assuming that the earnings forecasts that we're using, the earnings numbers we're using, are going to play out as the economy and earnings play out through 2018, 2019. So from a performance of the financial markets and economic variables point of view, from the point of view of valuation, looking really hard at interest rates and where we think they're going, and they're going to be going higher, earnings and where we think they're going, and they're going to be getting stronger. It looks to me as though we've got further to go in this cycle. That doesn't mean we're going to let our guard down. When you're at 112 months in a bull market, you have to watch all of the kind of tea leaves, the variables that we watch that give us a clue as to when this cycle is going to end. And we've got to watch them now very, very carefully and not be afraid to reduce equity exposure for all of us when those signals tell us to do so. We know it's important to preserve capital for you, our clients, our important clients. Everybody's important. To reduce our equity allocation and to preserve capital when things go down. You know, the trees don't grow to the sky, and sooner or later we're going to have a bear market, and that might be accompanied by an economic recession. But we don't see that in the cards right now. If you were to ask me, if you were to put a gun to my head and ask me, look, Hugh, when do you think this is going to be over? I look very hard at the housing variables, which sometimes give me a tip-off. I look very hard at our forecast for interest rates. When are interest rates going to get to that level that are simply too high, and that the level of interest rates is going to simply overwhelm the good news about rising earnings? I don't think that happens until the second half of 2019 at the earliest, and maybe the first half of 2020. But that's when I think we've got to be even more on our toes than we are now. We're got to be on our toes now. We have to get really on our toes when we get to that point in time. So that's what I see going on. Obviously, there's a lot of things going on in this world of ours. The geopolitical events, the concerns about North Korea, Iran, all of the kinds of things that are going on that could be very disruptive, destabilizing, will impact the performance of the financial markets going forward. When I'm asked the question, Hugh, what do you think about North Korea? What do you think about the kind of turmoil that we see going on in Washington? What do you think about all of that? Doesn't that give you a good idea that we perhaps should back away from our exposure to the equity markets? And the answer is simply this. If those things are going to have a real impact on the economy, a real impact on earnings, we're going to see them show up in the performance of the financial markets. The financial markets will start to trend down. Investors will start to play it safe. They'll shift to the safer sectors of the market. Large companies are going to do better than small companies. There are lots of things that we look at which will tell us that it's time to sort of reduce our exposure to equities. But we, again, don't see that yet. Yes, I'm concerned about events that are transpiring in Washington. Yes, I'm concerned about the summit that's coming up with North Korea and how that might play itself out. Yes, I'm concerned about trade relations. I'm very concerned about trade relations between the U.S., importantly Canada and Mexico, and even more importantly Europe as well as China. Sure, we're concerned that that could be very disruptive to the ongoing expansion of the global economy. But right now, the message of the financial markets is as concerned as you might be about those, you should live with them. The performance of the financial markets, or investors collectively, are telling us that they're not going to cause a significant problem for the growth of the economy and the growth of earnings that we're currently watching. But again, we got to watch carefully. Really appreciate you being really good, loyal clients to us. You're very important to us. We know how important preserving capital is for you, and we're going to do our best to obviously identify the end of this current cycle and the start of a bear market that might be accompanied by a recession. We're on our toes. We're working on it every day. We've added some people to the firm. The firm is doing extremely well. We really appreciate that. We appreciate on an ongoing basis, obviously, the confidence that you show in us as being your investment managers, as well as all the kind of work we're doing with so many of you, and a big important part of our business, which is financial planning. The combination of doing financial planning and also investment management for you, our clients, individual clients, and doing really good investment management for those of you that are not individual clients but are not-for-profits, institutional clients. We're putting a lot into it, and we appreciate the confidence you've shown in us. We think we're getting better and better. Excellence is the number one word around here. We want to get very, very good, even better, at all of the things we kind of do for you. And again, once again, thanks for your loyalty. Thanks for your confidence, and you can expect more and better in the future. Thanks very much.